Hey everyone, welcome back to another video. In today's video, I'm going to be talking about two stocks that have outperformed the market over the last year, and each of these stocks are trading below their intrinsic value per share. So in this video, I'm just going to look into their financial statements as well as their earnings results for the last second quarter of 2022 to figure out if these two stocks present a good buying opportunity from a value investing perspective. And then to end off the video, I'm just going to compare the stocks against each other using a little competitor analysis since both of these stocks are competing in the same industry. So thanks in advance for leaving a like on this video, and let's get right into it. So the first stock that I want to talk about is Caleres, and Caleres is basically a retail company that basically focuses on selling footwear and growing their brand. We can see that over the last year, their stock has increased about 2% to 3% in the same year that the S&P 500 is down 12%. So they are beating the market at the moment. And if we look into their financial statements here, their earnings results for the second quarter of 2022, we can see that they've experienced some pretty strong sales growth as well as some pretty strong earnings growth. Their net sales increased by 9.3% up to $738.3 million, and just the year before that it was only $675 million. They have a gross profit margin of about 45.6%, so that's really good. That's going to help them obviously increase their profits since there isn't much cost that they're experiencing from their cost of goods sold. And then we see from their net earnings that they had about $51.2 million, which is up from $37.4 million year over year. And their earnings per share came out to be about $1.38 per share, which is up from 97 cents per share year over year. So definitely pretty strong earnings growth for Caleres for the second quarter of 2022. And then right underneath that, we can see their balance sheet, which gives us a look at the financial position for their company. And we can see that they're comparing their year-over-year results, and we can see their total assets have increased year over year from about $1.8 billion to what is now about $2 billion. So their business is expanding, which is a good sign. And we can also see that the majority of their business is financed by liabilities as opposed to equity. They have total equity of about $384 million, which means they have total liabilities of about $1.6 to $1.7 billion. So obviously, this is going to increase their return on assets because they don't have much equity sitting on their balance sheet. But at the same time, because their business is so heavily financed by debt as opposed to raising money from shareholders, they are going to be eating away into their cash flows by making interest payments on their long-term debt. And lastly, we have their cash flow statement, and we can see that their net cash provided by operating activities in the second quarter of 2022 came out to be about $27 million, which is actually down from $135 million in the second quarter of 2021. But we can also see in their financing activities that they returned a pretty hefty amount of value back to their shareholders. They returned about $5.2 million worth of dividends back to their shareholders, and they also repurchased about $41 million of treasury stock, acquisition of treasury stock. So definitely a lot of value provided to their shareholders in that regard. And so next, what I want to do is use this discounted cash flow model to figure out what the intrinsic value per share of Caleres company is at the moment. And these estimates I got from Yahoo Finance. So basically, analysts on Yahoo Finance are estimating that Caleres is going to grow at a rate of about 15% for the next 5 years. And so for the next 5 years after that, I was just conservative and I cut that value in half to 7.5%. They had about $150 million of free cash flow in 2021, which is when our analysis is starting. And then we can also see that if I net their cash against their debt position on their balance sheet, that they have a net debt position basically of about $840 million. And they also have 36 million shares outstanding. So taking these metrics into account, we can see that the intrinsic value per share for Caleres is estimated to be about $57 per share, with a 50% margin of safety of $28 per share, which compared to their current share price means that Caleres is currently trading below a 50% margin of safety relative to their intrinsic value per share for their company. So obviously, considering the fact that coupled with the fact that they've beaten the market over the last year, and they've experienced some pretty strong earnings growth over the last quarter. Shows that Caleres could potentially present a pretty good buying opportunity from a value investing perspective. But let's compare them against one of their main competitors, which is Shoe Carnival. And we can see right here from this 5-year chart that Shoe Carnival is up about 170% over the last 5 years. Just for comparison, Caleres is actually down 2% over the last 5 years. So on the 5-year chart, they're not doing so well. But contrary to that, Shoe Carnival, they're doing very well over the 5-year chart. But then over the 1-year chart, they're down about 30 to 40%. So obviously not doing too good on the 1-year chart. But obviously a lot of wealth is made in down markets. So if Shoe Carnival is growing their business, then this could present a potential buying opportunity, especially considering the fact that over the last 5 years, they've also beaten out the S&P 500's 5-year performance. So if we look at their financial statements here, the first statement is their balance sheet, and we can see that compared to the prior quarter, that they had total assets of about $861 million as of the second quarter of, or as of April 30th, 2022. And then we can also see that their business is pretty much split down the middle 50-50 in terms of being financed by debt versus equity. They have $406 million of total liabilities sitting on their balance sheet and $455 million worth of total shareholders' equity sitting on their balance sheet. And we can also see, curiously enough, that their shareholders' equity has increased from the prior quarter as well as year over year. And that's come primarily as a result of a massive increase in retained earnings. We can see that 1 year ago they had about $447 million of retained earnings, and now they have about $577 million of retained earnings. So that's pretty massive growth for their earnings over the last year or so. And it's good to see that the total equity for a company is increasing as a result of retained earnings. Because if it was increasing as a result of, say, for example, an increase in additional paid-in capital, then that would basically mean that the equity position in their company is increasing because they're diluting their previous shareholders by issuing new shares to raise money, which might not be a good sign. But in this case, it looks like it is a good sign because their business is growing as a result of an increase in retained earnings. And so if I scroll down here, we can see their income statement. And interestingly enough, their earnings for the second quarter of 2022 weren't that great. We can see that their net sales year over year actually declined from about $328 million to $317 million. They have a gross profit margin of about 36.2%. And we can also see their net income is down from about $43 million 1 year ago to now about $26.8 million as of the second quarter for Shoe Carnival. And we can also see, because of that, their earnings per share also declined from about $1.51 per share to about 95 cents per share. So not very strong earnings growth for Shoe Carnival, despite the fact that we've seen that their retained earnings growth has been pretty massive over the last year. And to finish off the financial statement analysis for Shoe Carnival, we have their cash flow statement here. We can see that they had net cash provided by operating activities of about $17.7 million, which is down from $76 million in the prior year. And we can also see that they returned a little bit of value back to their shareholders in the way of about $2.5 million worth of dividends paid, as well as purchase of common stock for their treasury stock account of about $20.5 million. And so if we look at the intrinsic value per share for Shoe Carnival here, we can see that they're estimated to grow at about 10% per year compounded annually over the next 5 years. They had about $163 million worth of free cash flow in 2021. They have about a net debt position of about $150 million on their balance sheet, and they have 27 million shares outstanding. So with those facts in mind, we can see the intrinsic value per share is estimated to be about $87 per share, with a 50% margin of safety of about $43 per share, which compared to their current share price means that Shoe Carnival is trading at a much lower discount relative to their intrinsic value per share than Caleres was. Caleres was trading at $25 per share, and their intrinsic value per share was about $28. Shoe Carnival's intrinsic value per share is about $43 per share, and they're trading at $23 per share. So despite the fact that their stock is up almost 200% over the last 5 years, completely beating out the S&P 500's 5-year performance. Their stock price right now is basically trading at almost half of a 50% margin of safety relative to their intrinsic value per share, which means they could potentially present a good buying opportunity. But if we look on the right side here, just to finish off the video, we can see with a competitor analysis here, I compared the two stocks or the two companies against each other based on some of their efficiency ratios. We can see that Caleres actually has a better gross profit margin than Shoe Carnival of about 43% versus 39%, but Shoe Carnival has a higher net profit margin in comparison to Caleres. So they have about a 12% net profit margin compared to Caleres' 5% just about. And then in terms of return on assets, we can see that Shoe Carnival is way more efficient in terms of getting a return using the assets on their balance sheet at about 20% return on assets versus Caleres' 6.75%. So their competitor analysis here, their ratios are kind of mixed up. We can see that Caleres is beating them out in gross profit margin, but in terms of return on assets on the bottom line, Shoe Carnival has them beat in that regard. So based on this, I'll probably say that Shoe Carnival has the upper hand in terms of business efficiency. And then we can also see that they are trading at a much lower discount relative to their intrinsic value per share than Caleres is. And then on top of that, their 5-year chart is also beating out Caleres' 5-year chart. However, we saw from their financial statements that Caleres had strong earnings growth year over year, whereas Shoe Carnival actually had an earnings decline year over year. So if we're going to judge them based on their financial statements, it looks like Caleres could potentially be a better buy. But if we're going to judge them based off their stock performance as well as their discounts relative to the intrinsic value per share and the business efficiency based on their financial ratios, I'd probably give Shoe Carnival the upper hand in this case. But both stocks are trading below their intrinsic value per share and potentially could be buying opportunities at the moment. But I would definitely love to know what everyone watching this video thinks about these two stocks. Does anyone think that these are good buying opportunities in the market at the moment? Let me know in the comment section down below. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.